Okay, let's dive into this explainer. Today, we are unpacking a really fascinating market paradox that's currently playing out in precious metals, and this is all based on some of the latest reporting from Kitco News. I absolutely love it when the market throws us a curveball, and right now, well, we have a fantastic puzzle to solve. We're essentially looking at a situation where the standard economic rulebook seems to have been tossed right out the window. If you follow the markets, you know certain assets are supposed to behave in highly predictable ways when specific economic data drops. But what happens when the data says one thing and the asset does the exact opposite? That is exactly the dynamic we're going to dissect today.
So, we're exploring a classic economic mystery. The U.S. labor market is genuinely starting to show some cracks. Yet gold, which is typically our ultimate safe haven asset, is actually in a tailspin instead of soaring. Think about this for a second. Historically, the very moment the labor market starts to wobble, investors get nervous, right? They pull their capital out of riskier assets and they park it in the perceived safety of gold. I mean, it's a tale as old as time in the financial world. But today, the gold market is acting like it hasn't even read the headlines. It is completely ignoring the weakening labor data. So why on earth is that happening? Well, to figure that out, we need to look at the exact numbers on the ground right now. Right now, the spot price of gold is sitting at exactly $4,067.90 an ounce. It remains firmly caught in a downtrend, and it's heavily testing some really critical long-term support levels. For those of you tracking this day to day, seeing gold just kind of hover at this level, roughly unchanged, despite the broader economic whispers, is quite a standoff. A downtrend just means sellers are maintaining control, pushing that price lower over time. And a support level, well, that's basically the floor. It's the price point where historically, buyers step back in and say, okay, that's cheap enough, I'm buying. But the fact that we are testing those floors, rather than bouncing forcefully right off them, tells us market sentiment is surprisingly heavy. Something is definitely keeping a lid on gold prices. Now, the catalyst for this whole paradox really came when the Labor Department announced that initial jobless claims hit 229,000 for the week ending June 6th. That is an increase of 4,000 from the previous unrevised week of 225,000. But the absolutely crucial part here is the comparison to the forecast. The consensus estimate had forecast a reading of 220,000 claims, so we completely overshot the expectations. On paper, this is exactly the kind of slowing momentum in the labor market that should send absolute shockwaves through trading desks. When initial jobless claims rise faster than economists predict, it's usually the smoke that signals an economic fire.
Usually, an unexpected jump in unemployment claims like that sends folks running straight for gold. That's our standard economic expectation. But the current market reality, it is entirely different. The market is completely shrugging off this weaker than expected data. Kitco News is reporting that the gold market is showing very little reaction whatsoever. It just remains caught in that tailspin we discussed. And honestly, this is exactly why this explainer is so crucial. If you only looked at the jobs miss, you'd assume gold was rallying hard. But the reality is completely detached from that short-term data point. There just has to be an anchor holding the broader market steady.
And that brings us to the resolution of our mystery. Analysts and economists, they aren't just looking at 1 week of data in a vacuum. They're weighing the short-term weekly claim bump against the very strong employment growth we saw back in May. When you zoom out and look at the big picture, the conclusion is that the broader labor market actually remains quite healthy. It's kind of like the difference between hitting a minor pothole and seeing a structural bridge collapse. The market has basically decided that 229,000 jobless claims is just short-term volatility. It's a pothole, completely offset by the incredibly strong foundation laid down in the previous month. So the really crucial takeaway here is that because the broader employment picture actually looks stable, gold simply isn't getting its usual fear-based boost. Without that safe haven money rushing in to buy, the price just stays heavy. And this leaves analysts hyper-focused on one very specific, very important number, $4,000 an ounce. This is the critical price support level they are watching incredibly closely. Why does this matter to you? Well, in technical analysis, big, round, psychological numbers like $4,000 act like massive magnets. If the healthy job market narrative holds up and sellers keep pushing, breaking below $4,000 could trigger a whole new wave of selling. Conversely, if that support holds, it proves there's still some serious underlying strength in the metal. Section 1. The 2026 Horizon. From short-term support to wild long-term forecasts. Now, if we pan out from those immediate daily numbers and that super tight focus on the $4,000 support, institutional analysts are painting a wildly different canvas for precious metals. Looking at the broader trending forecasts, the projections are, frankly, staggering. First up,
ING's Manthe predicts gold will navigate its near-term headwinds to hit $5,000 an ounce by year-end. Guys, that's roughly a 25% increase from where we're sitting right now. Then we have silver, with market trends indicating a massive structural shift that could push the price above $80. And then there is the legendary Pierre Lassonde, forecasting a long-term target of $17,250 for gold. I mean, wow! These aren't just minor upticks we're talking about. These are tectonic shifts being forecasted by major industry heavyweights.
So you might be asking yourself, how on earth do we get from a sluggish $4,000 today to those absolutely massive targets? Well, these projections are being fueled by some incredibly complex macroeconomic factors. It is a potent cocktail of global pressures. We're talking about CPI risks, meaning sticky inflation, lifting yields. We're seeing geopolitical forces like optimism surrounding Iran impacting potential gold gains. There are expectations of strong silver output in 2026. And overall, there are deep, fundamental, structural shifts happening in the global economy right now. This is really what you should take away from all this. The day-to-day jobless claims, that's just noise compared to these massive, slow-moving geopolitical and macroeconomic tectonic plates.
But maybe the most eye-catching projection, the one that really forces you to stop and think, comes from Pierre Lassonde. He points directly to a looming $40 trillion U.S. debt crisis as the ultimate runway for gold to eventually reach that astronomical $17,250 an ounce. This represents the absolute ultimate bull case for gold. We are no longer talking about weekly jobless claims missing by 4,000. We are talking about a $40 trillion sovereign debt issue. When debt scales to numbers that insanely large, analysts like Lassonde believe it fundamentally changes the value of fiat currency itself, making hard, tangible assets like gold incredibly valuable over the long haul. So, this brings us to the ultimate question we really have to grapple with today. While gold struggles near $4,000 right now, heavily weighed down because the broader employment data actually remains healthy, we have to ask, will this short-term pressure ultimately be completely overwhelmed by these massive, long-term debt and structural forces? Are we just staring at a calm surface right now while a massive tidal wave of a $40 trillion debt crisis builds silently underneath? It's a profound market paradox for sure, and exactly why watching these levels and truly understanding the underlying data is so incredibly important.